Good morning, folks. So today I'm in a very nice place. It's called the Georgia Sunshine Village, and we've come here for our annual retreat. Perfect place to catch up on the week. Okay, so let's start. Sunshine around, but the newspaper headline says macro headwinds cloud IT firms' growth outlook. Okay, so the basic worry is that recession is going to bring down the business for our IT firms. So I shouldn't even be saying the worry is recession. The worry is a possible recession may bring it down. There's no, as I was saying last time, there's no actual evidence yet that there's a recession. But analysts being analysts are going to be saying that. Concerns over recovery in FY26 persist, with rising risks stemming from tariff wars and inflation. Analysts reckon that the final quarter of FY25 may see improved client demand, particularly in the financial services sector. Okay. However, the recent commentary from Accenture after its Q2 results has raised concerns about growth prospects for FY26. If you remember, we spoke about how Accenture has been losing or not been able to renew their contracts with the US government, and hence bringing down their forecast by almost 6 to 8%. Okay, so this gets extrapolated. But there's a very different view also from Macquarie, and they say, while we agree that whether the US slips into a recession remains something to watch for, we think this might only cause a temporary air pocket, as recessions usually drive further cost takeout programs and help drive up outsourcing demand, right? So they're saying if there's a recession, then companies are going to be looking to reduce their costs. How do they reduce costs? By outsourcing more. So there seems to be water in what Macquarie also says, you know. I tend to look at it with a kind eye. Then going inside, it says small cap funds stuck in liquidity mud. Not a nice sounding headline. But the hard reality is that the traded volume in small cap stocks is so less. If you have a large position, it's very difficult to sell it off in one day. Even if you take a few days, and you'll be lucky if you can sell it all off at a reasonable price. Most often the stocks get discounted when you start selling them, which is why building small cap, mid cap positions is rather tricky and requires a lot of skill from the fund manager's side. Okay, so here the headline says, sell time drags. 37 days needed to clear 50% of holdings, which means that if you want to sell half your portfolio into the small cap fund, you're going to need 37 days. And it has gone up, by the way. All right. So one has to be wary of this. Whenever the number of days taken to sell off your portfolio goes up, it means that when they sell, the discount could be much more than anticipated, bringing down your returns from your small cap investment. So liquidity is a big factor to look out for, and any small cap investor should be worried about that, especially at this point of time. Okay. The Mint says on the same day, there's a gold rush for silver. A gold rush for silver. Will it persist? Okay, interesting, right? So all investors have been running after gold, and they've forgotten to buy silver. And silver has been, not quietly, silver has been breaking up its gains over the last 1 year too. And silver has performed very well. But it also says across the globe, both these precious metals have outperformed major asset classes like equities and debt so far. In the last 5 years, however, silver has outperformed even gold, returning almost 178%, while gold gained 106%. Okay, so that's a fact for you, but there's always a but. Okay, how should investors approach silver? Now, you're listening to this, you may be inclined to buy silver, but listen to this. Okay. Investors can gain exposure to silver through futures contracts traded in the multi-commodity exchange, very risky, okay, or through exchange traded funds by mutual funds. Okay. However, they must have a high tolerance for volatility, said experts. Dubbed the devil's metal. Listen to this. Silver is dubbed the devil's metal because of its history of extreme erratic behavior during industrial demand headwinds. So I think even earlier I was saying, if you're looking at the last 15 years, gold had 3 bad years, silver had 6 bad years. So that gives you an idea of the volatility of silver and how much more careful you should be. A very nice edit inside, okay, and anonymous guys write best. Okay, so here's a column called Markets with Bertie, and the headline reads, when the pharma industry is stuck with nowhere to hide. Very interesting. I mean, healthcare has been up there in most desired sectors. So why does he think they are stuck? A very interesting observation. Okay. So while Bertie has gone through a lot of charts on healthcare and consumption of medicines in India, he goes, unable to reconcile these seductive charts and exhibit reality, Bertie posed a question to the CEO of a large pharma company. Okay. He asked, and the CEO replies, we have been victims of our success in a way. Effective combination drugs and better delivery mechanisms like extended release capsules mean that the number of pills you have to take has gone down. Most of us who have not been keeping up to our health or family, you can see that, right? Okay. Remember the time when you swallowed 3 pills 3 times a day? Now it's generally twice a day and probably just 2 of them. Okay. So Bertie asks, but shouldn't that get adjusted in price? You know, lower volume but higher prices should take care of forever growth, right? The CEO smiled. In theory, it should, but the industry is competitive. 1 + 1 adds up less than 2. 1 + 1 adds up less than 2. On top of that, now there are barbarians at the gate. Trade generics which market the cheaper products directly to the distributor, and even cheaper, Jan Aushadhi, which is a generic. So while you think there have been a lot of advancements in the technology, reducing the number of tablets you have to take, but the competition from cheaper generics, other markets, is driving profit margins down for pharma companies. Let's keep that in mind. Okay. And a very interesting observation, apparently Bertie has bought an EV. All right. Having read everything about EV's demand going up and its popularity. But the problem comes up when he tries to find a charger. And he says his RWA did not allow him to put a charger in the basement. And these kind of problems are going to be encountered by many EV buyers. So where's the demand coming out from EV? Okay, if it is not the apartment owners who are buying it. Apparently there's a large demand for EVs from tier 2 places. And those who own bungalows and villas, of course, but a large tier 2 demand coming up. So the Tuesday's Business Standard has a interesting headline. Large cap, low volume funds dominate fund houses' new offerings. Large cap, low volume funds. Oh, this is what happens when engineers write financial headlines. Okay, it's supposed to be large cap, low volatility funds. The editor was sleeping. Okay, so what does it say? Quality focused funds also gain traction amid shift in market trends. Okay, so in the last few months, a lot of launches have taken place by AMCs, and since the start of February, fund houses have sought approvals from SEBI for 44 scheme launches, including 13 debt and 27 equity funds. A majority of these equity funds follow strategies large cap, quality and low volatility that were out of favor with investors in recent years, which means to say that quality and low volatility are likely to make a comeback, going by the trends of the fund launches and what the newspaper report here is saying. Okay. Among the upcoming offerings are several passive funds tracking indices such as the Nifty 200 Quality 30, then the Nifty Top 10, 15, 20 Equal Weight, the Nifty 500 Low Volatility 50, and the Nifty 100 Low Volatility 30, and the BSE Low Volatility. So a lot of quality and low volatility funds. Some of you may be familiar with these funds, having been associated with Hexagon. So let's hope that these guys pick up well and do the kind of work they're supposed to do in your portfolios. Okay. So we come to Wednesday's Business Standard, and here again, those who are familiar with or have invested in balanced advantage funds, which is a dynamic equity and debt allocation fund. So here the headline reads, BAF equity exposure off lows as valuations improve. So the graphic here comparing HDFC, ICICI Pru, SBI, Kotak, Edelweiss and Tata balanced advantage funds. And in all the cases as compared to August 2024 and February 2025 portfolios, they have all initially had a low and they have all increased their equity exposures in the recent slump. That's what one is supposed to be doing, right? Buying when markets are low. These BAFs have exactly done that, and some of them have come off a low of 30% in equity to almost 46-47% in equity and almost 49% in equity, which is good. You bought a lot more equity when the markets have fallen. I'm happy reading headlines like this. So coming to debt, okay, we spoke about gold and silver and equity. So debt. So in the last few days, there has been a good inflow of FPI investors in Indian debt, Indian approved debt, which is a good thing. We've been waiting for this to happen. We've been talking about this for such a long time. Now it's happening with some 3,000, 4,000 crores coming into Indian government securities. And as a result, we had 10-year government bonds increasing in price and the yield falling from almost 6.74, 6.75% to 6.62%. Okay. And also interestingly, when the RBI conducted an auction, the result on the headline, 3-month treasury bill cutoff set higher than 1 year, inverses yield curve. Very technical, but let me put it in simple terms. The 90-day borrowing by the Government of India or the Reserve Bank of India, which is a treasury bill, is at a higher rate of interest than what the government would pay for a one-year treasury bill. Strange, right? Generally, shorter term borrowings should be at a lower rate of interest and longer term at a higher rate of interest. But here the reverse happened. Shorter term government had to pay more to borrow. Why this anomaly? Nothing to do with recessions or any such things. Simple that investors, as per this article, are expecting interest rates to drop in the coming monetary policy meetings of the RBI, and hence they'd rather hold a one-year treasury bill at which would be at a higher rate of interest than the post-interest rate assumed drop. Okay, so there was no demand for the 90-day treasury bill, because of which the government had to pay a higher cutoff. So this is eventually coming down to demand and supply. If there's no demand, then the rate of interest goes up. If there's high demand for the bond, the rate of interest comes down. So let's remember that basic fundamental demand supply eventually influences all pricing. Okay. So Thursday, those who've been following the IndusInd saga of the bad audit and bad disclosures on derivatives, more bad news. Okay, what is it? Thursday's headline says, insider trading shadow looms over IndusInd Bank. Okay, so regulator seeks details of trades by 5 senior bank personnel who had price sensitive info and apparently sold with insider knowledge, okay, before the stock price fell for the public. So obviously insider trading is not looked upon kindly by any regulator, any respectable regulator in the world, and so on with India also. So the lack of good governance shows up at times like this, when they are trying to fudge records, or there's insider trading, promoters indulging in insider trading. All this points to bad governance. And if you'd ask me, I would rather buy a business which has good corporate governance and I could trust it forever, rather than bad corporate governance. Okay. Inside headline is not insider. Inside headline is GE delivers first engine for indigenous light combat aircraft Mark 1A. We've been waiting for this for a long time. HAL took on so many orders and could not execute. Or just contrast this. Their inability to deliver aircraft as compared to the stock price. I think you'll find some dissonance there. Okay. So the headline says 12 engines to be delivered this year. Marks start of supplies delayed due to supply chain constraints. HAL to ramp up production and fighter deliveries next. Okay. So there's been a fair amount of back and forth in between the defense chiefs and the HAL management about the slow production of aircraft. They've fallen way behind their contractual terms. And the article says GE, who makes the aircraft engines, GE acknowledged delays in supplies, saying it has shut down production line for engines in 2016 when earlier orders had been fulfilled, and restarting it was a complex task. It just brings to focus, whatever be the reason, our dependency on critical suppliers is going to determine how quickly we are able to produce the finished goods, in this case the fighter aircraft. If GE is not able to, or GE won't supply for whatever reasons, we are stuck. Let's remember this vulnerability in our defense production before paying a high PE for the stock. Anil Padmanabhan, a journalist, interesting editorial in the Economic Times. So he says, why we are in the doldrums. Doldrums spelled as DOLE-DRUMS. How giving out doles is impacting the entire economy. So apart from that, the interesting paragraph here is quoting another report. He says, the stratification of demographics based on per capita income, $12,000 per capita, $3,000 per capita, and $1,500 per capita earning people. This stratification frames the new political economy of India, in which the top 20% account for 80% of discretionary spending. A whole new meaning for the 80-20 rule. Okay, manifesting in growing premiumization of the consumer economy, while the balance holds the key to electoral power. So the 20% who contribute to 80% of consumption are influencing consumption, and the 80% who are not able to spend as much because of their low levels of income are the ones who are the vote banks. Okay, this kind of dichotomy is going to put political parties in a fair amount of dilemma as to who are they, how their policies are going to be framed. The political space that is being created is being swiftly occupied by political parties and civil society groups, which till now prefer to remain in the background. Unsurprisingly, India has witnessed a spike in public protests, with parties choosing to leverage anxieties. The most prominent instance has been the prolonged stir by farmers, first against the farm laws and later to demand a law to make MSP permanent. So the face-off between aspirational politics and anxiety politics has already caused the government of India to slow down the rollout of much-needed economic reforms. See how it eventually impacts economic reforms, and whether you're in the 20% or the 80%, it hits all of us. If not reversed, it could well derail India's audacious ambition to transform into a developed economy by 2047. Politics can make us or break us. The Finance Ministry came out with some reports on growth. The headline says, trade uncertainty, geopolitics are risks to growth. Okay, this is what the Finmin's review says, and calls private investment an important driver of economic growth in the next fiscal year. Okay, I think last time I was speaking about the Adani Group committing more than ₹1 trillion to capex. We want more of such things. Anyway, the report says the Indian economy seems on track to grow at the estimated pace of 6.5% in the current year, riding a strong performance in the March quarter, stating that private investment will be an important driver of economic growth in FY26. Okay, but in any case, the review report goes on to say, list on the bright spots. What are the bright spots for growth? Benign global commodity price outlook. That means if commodities are not going to be spiked up, then as a consumer, as a manufacturer, it's going to help us if the input prices are lower than expected. Steady domestic growth prospects, easing inflation, strong rural demand, improvement in the labor market, rise in liquidity, good farm services sector's performance. Okay, and then a rate cut in February and the latest income tax relief. The budget's growth and reform focus. All these are touted to be the bright spots in the Indian economy. The risk factors are geopolitical tensions, we've spoken about it, global trade policy uncertainties, financial market volatility, and the trade policy impact to extend beyond the US. Okay. What are the prescriptions? The prescriptions are two here. Private sector should recognize its investment and broader consumption are linked. India should not import pervasive cynicism and pessimism from abroad. Oh man. Okay, I think the kind of pessimism that has been clouding everybody, whether they're going to be impacted or not, everybody is becoming cynical and pessimistic. I think one needs to look at the data with a hard eye and then only decide whether we are impacted. For example, India's exports to the US, a very tiny percentage of our GDP. So how much are tariffs going to impact our GDP? Not as much as one would like to think. I'll try to get some data for next time. There was also a very interesting editorial by Akash Prakash in one of the newspapers, and he's worried that with all the trade sanctions, tariffs, non-tariff barriers, China is going to be feeling the heat as one of the largest manufacturers and exporters, correct? We all know that. The point is, if all that production is going to get happen in China in any case, it will get bottled up and eventually it has to go out somewhere, right? So this entire production will go to other emerging and developing countries, the global south as Akash Prakash calls it. They are going to be recipients of cheap exports by China. Just imagine if you have a whole bunch of cheap exports from China into India, what we would call dumping, what happens to our own manufacturing sector? Our own manufacturing sector is not going to find it very profitable to make if Chinese goods are competing at a much lower price. So he says that if India is not quick in putting up anti-dumping rules and putting up the appropriate barriers to dumping by China, our manufacturing growth will be impacted. So let us be mindful of that. And on that note, let me end this week's podcast. Thank you for listening to me.